Every day, trillions of dollars move invisibly around the world between banks, governments, and countries through a system most people have never heard of and almost no one fully understands. Hey, I'm Astrid, and today I'm going to teach you how the global financial system actually works. Not the simplified version. The real one, the infrastructure, the institutions, the mechanisms, and the hidden connections that determine what happens to your money, your economy, and your country when things go wrong somewhere else in the world. Because here's what most people don't realize. Every financial crisis, every currency collapse, every bank failure that has ever affected ordinary people started somewhere in this system. Understanding how it's connected doesn't just satisfy intellectual curiosity. It tells you why things happen and helps you see the next disruption before most people do. Give me 15 minutes. Nothing here is financial or investment advice. Global finance is complex, circumstances change, and your specific situation requires specific guidance. What I'm giving you today is the foundation most people never get. To understand the global financial system, you need to start with one foundational idea. Money doesn't just sit somewhere. It moves. Constantly. Across borders, through institutions, between currencies, at speeds and volumes that are almost impossible to fully visualize. Think of the global financial system as a circulatory system. Just like blood moves oxygen and nutrients to every part of the body, money moves capital, credit, and purchasing power to every part of the global economy. When that circulation works well, economies grow, trade happens, and standards of living improve. When the circulation breaks down, when credit freezes, when currencies collapse, when trust disappears, the effects spread through the entire system quickly and painfully. The 2008 financial crisis didn't start in your country. It started in the U.S. housing market, spread through the global banking system, and within months was affecting job markets, credit availability, and economic growth in countries that had nothing directly to do with American mortgages. That's the circulatory system failing. And understanding why that happens, the actual mechanics of how a problem in one part of the system reaches every other part, is what the next 15 minutes are about. Let's build this from the ground up. Every layer connects to the next. The dollar as the world's reserve currency. Before we can understand how global money moves, we need to understand what it moves in. And for the majority of global trade and finance, the answer is the US dollar. The dollar's status as the world's primary reserve currency is not an accident or a permanent law of nature. It's a historical outcome with specific origins and ongoing implications that affect every country on Earth, including those that don't use dollars domestically. After World War II, the Allied nations met at Bretton Woods, New Hampshire, and established a new international monetary framework. The dollar was pegged to gold at a fixed rate, and other currencies were pegged to the dollar. The U.S. had emerged from the war as the world's dominant economic and military power, holding the majority of the world's gold reserves. The dollar became the anchor of the global financial system. In 1971, President Nixon ended the dollar's convertibility to gold, what's known as closing the gold window. The Bretton Woods system ended. But the dollar's dominance didn't. By that point, global trade, oil pricing, and financial markets were so deeply integrated with the dollar that shifting away from it was enormously difficult. The infrastructure of global finance had been built around it. Today, the dollar remains the world's primary reserve currency. Approximately 60% of global foreign exchange reserves are held in dollars. The majority of global commodity trade, including oil, is priced in dollars. International loans and bonds are predominantly denominated in dollars. When countries want to trade with each other, they often convert to dollars first. This creates something economists call the exorbitant privilege. The United States can borrow in its own currency, which means it can never be forced to default on dollar-denominated debt the way other countries can. It can always print more dollars. It also means there is always global demand for dollars, which keeps U.S. borrowing costs lower than they would otherwise be. But the privilege comes with responsibilities and tensions. When the U.S. Federal Reserve raises interest rates to manage domestic inflation, capital flows toward dollar-denominated assets from around the world, pulling money out of emerging market economies, strengthening the dollar. and making dollar-denominated debt more expensive for developing countries that borrowed in dollars. A domestic U.S. monetary policy decision ripples through every economy with significant dollar exposure. This is the first layer of the global financial system. The dollar is not just America's currency. It's the world's operating currency. And the Federal Reserve is, in many ways, the world's central bank, even though its mandate is domestic. SWIFT and the payment infrastructure. Now that we understand what currency dominates the system, let's talk about how money actually moves between countries. When a company in Germany pays a supplier in Japan, the money doesn't literally travel. What happens is a series of messages and ledger adjustments between financial institutions, facilitated by a network called SWIFT. SWIFT stands for the Society for Worldwide Interbank Financial Telecommunication. It's a messaging network that connects over 11,000 financial institutions in more than 200 countries. It doesn't move money directly, it sends the instructions for money to move. Think of it like the postal system for financial instructions. When a bank in one country needs to send funds to a bank in another country, SWIFT carries the message that initiates that transfer. SWIFT was founded in 1973 to replace the inefficient, error-prone telex systems that banks had been using for international communication. Today, it processes millions of messages per day, carrying instructions for trillions of dollars in transactions. What makes SWIFT important beyond its operational function is its role as financial infrastructure and therefore as a potential tool of geopolitical pressure. Because most international transactions require SWIFT to process, being excluded from SWIFT is effectively being cut off from the global financial system. In 2022, following Russia's invasion of Ukraine, several major Russian banks were removed from SWIFT as part of Western sanctions. The immediate effect was significant disruption to Russia's ability to conduct international financial transactions. SWIFT is not the only payment infrastructure. There are alternatives, and countries like China have been developing parallel systems, but it remains dominant. Understanding SWIFT means understanding that the technical infrastructure of global finance is not neutral. It reflects and can be used to enforce geopolitical power. Correspondent banking. Even with SWIFT sending the instructions, money doesn't move directly between every bank in the world. Most banks don't have direct relationships with every other bank globally. Maintaining those relationships is expensive and complex. Instead, international payments typically flow through correspondent banks, large financial institutions that maintain accounts at each other and act as intermediaries. When a small bank in Brazil needs to send money to a small bank in Thailand, the payment likely flows through a major correspondent bank in each country and potentially through one or more global correspondent banks in between. This system works, but it creates layers of fees, delays, and opacity. A payment that appears to move from A to B may actually travel through C, D, and E, each taking a small fee, each adding a small delay. For large corporate transactions, this is manageable. For individuals sending remittances, money sent home by workers in foreign countries, these fees can represent a significant percentage of the transfer amount. Remittances are one of the largest flows of money in the global financial system. They represent a critical source of income for many developing economies, in some countries exceeding foreign direct investment as a source of external income. The cost and friction of the correspondent banking system has historically made remittances expensive to send. New financial technologies, including mobile payment systems and, more controversially, certain cryptocurrency applications, are attempting to reduce this friction. The Eurodollar system. Here's where most explanations of global finance stop, but where the system gets genuinely interesting. Most people understand that dollars circulate inside the United States. What's less understood is that an enormous quantity of dollar-denominated financial activity happens entirely outside the United States in what's called the Eurodollar system. The name is historical and slightly misleading. Eurodollar doesn't refer to the euro. It refers to US dollars deposited in banks outside the United States. The system originated in the 1950s and 1960s when the Soviet Union and other entities wanted to hold dollar deposits, but didn't want those dollars subject to U.S. legal jurisdiction. They deposited dollars in European banks instead. The euro prefix referred to European banks, not European currency. Today, the euro-dollar system is vast. Estimates suggest that the majority of dollar-denominated activity in the world happens in this offshore dollar market. Banks outside the U.S. can borrow and lend in dollars, create dollar-denominated financial instruments, and facilitate dollar-denominated trade entirely outside U.S. borders and outside Federal Reserve oversight. This creates a peculiarity that matters enormously in financial crises. When there is a sudden global demand for dollars, which happens in almost every major financial crisis because dollar-denominated debts need to be repaid in dollars, the Federal Reserve is the only institution that can create dollars. But the demand is coming from a global system that is far larger than the domestic U.S. financial system. This is why the Fed established swap lines with other major central banks during the 2008 crisis and again in 2020, essentially lending dollars to foreign central banks so they could provide dollar liquidity to their domestic financial systems. The euro-dollar system is invisible to most people, but it's the reason a liquidity crisis in one part of the world can become a global dollar shortage almost overnight. International Monetary Fund and the lender of last resort. When a country faces a severe financial crisis, a currency collapse, a debt default, a banking system failure, it often turns to the International Monetary Fund for emergency assistance. The IMF was created at Bretton Woods alongside the post-war international monetary framework. Its core function is to provide emergency lending to countries in financial distress, helping them stabilize their currencies, maintain debt payments, and restore economic confidence. It has approximately 190 member countries, all of which contribute to a pool of funds that can be lent to countries in crisis. IMF lending almost always comes with conditions, structural adjustment requirements that the borrowing country must implement in exchange for the funds. These conditions typically include fiscal austerity measures, currency adjustments, and structural economic reforms. The philosophy behind conditionality is that the crisis was often caused by fiscal or monetary mismanagement, and lending without addressing the underlying causes simply delays the inevitable. In practice, IMF conditionality has been deeply controversial. Critics argue that austerity requirements imposed during economic crises deepen the recession, increase unemployment, and disproportionately harm the most vulnerable populations, often the same populations who had the least to do with creating the crisis. The history of IMF interventions in Latin America, Southeast Asia, and Africa includes examples that are cited both as rescues and as cautionary tales, depending heavily on which aspects you examine and whose perspective you prioritize. What's not controversial is the role the IMF plays in the architecture of the global financial system. It functions as a lender of last resort at the international level, the institution that provides a floor under collapsing currencies and debt spirals when domestic resources are insufficient. Whether the terms of that floor are appropriate is a question that economists and policymakers continue to debate actively. The Bank for International Settlements. If the IMF is the global lender of last resort, the Bank for International Settlements, the BIS, is the central bank of central banks. Founded in 1930, the BIS is headquartered in Basel, Switzerland. Its shareholders are central banks. Its clients are central banks. Its primary function is to facilitate cooperation between central banks, provide banking services to central banks, and conduct research on global financial stability. The BIS hosts regular meetings of senior central bank officials, the Basel process, where the most powerful monetary authorities in the world discuss global financial conditions, coordinate policy approaches, and share information. These meetings are not fully public. The decisions that emerge from them, or the shared perspectives that develop within them, can influence monetary policy across multiple major economies simultaneously. The BIS is also where international banking regulations are developed. The Basel Accords, Basel I, Basel II, Basel III, are sets of international banking standards developed through the BIS process that determine how much capital banks are required to hold relative to their assets. These capital requirements directly affect how much credit banks can extend, and therefore how much money circulates in the economy. The rules developed in Basel affect banking systems worldwide. Shadow banking. One of the most important and least understood components of the global financial system is the part that exists outside traditional regulated banking, what economists call shadow banking. Shadow banking refers to credit intermediation, essentially the banking function of borrowing short and lending long, creating credit that happens outside the traditional deposit-taking bank structure and therefore outside traditional banking regulation. Shadow banking includes money market funds, hedge funds, structured investment vehicles, securities lending, repo markets, and a range of other financial entities and activities. These entities don't take deposits the way commercial banks do. They're not subject to the same capital requirements. They don't have access to deposit insurance or, traditionally, to central bank lender of last resort facilities. What they do is provide enormous amounts of credit and liquidity to the financial system. At the peak before 2008, estimates suggested that the shadow banking system in the United States was approximately as large as the traditional banking system. Globally, shadow banking represents tens of trillions of dollars in financial activity. The 2008 financial crisis was, among other things, a shadow banking crisis. The collapse of the repo market, a critical source of short-term funding for shadow banking entities, froze credit markets in a way that couldn't be fully resolved through traditional banking system interventions. The Federal Reserve ultimately had to extend its emergency lending facilities far beyond their traditional scope to address the shadow banking freeze. Shadow banking isn't inherently dangerous. It provides real and useful financial services. But its scale and its interconnection with the traditional banking system mean that stress in the shadow banking system can transmit to the broader economy rapidly and in ways that are difficult to predict or contain. Currency crises and contagion. Understanding the components of the global financial system matters most when things go wrong. And when things go wrong in global finance, they tend to go wrong in connected, cascading ways. A currency crisis occurs when a country's currency loses value rapidly, often in the context of a balance of payments crisis, where a country can no longer finance its international obligations. Currency crises are typically preceded by a combination of factors: large current account deficits, high levels of foreign currency debt, declining foreign reserves, political instability, or loss of investor confidence. The mechanics of a currency crisis often involve a self-reinforcing spiral. Investors begin to worry about a currency's sustainability. They sell assets denominated in that currency and buy dollars or other safe haven currencies. This selling pressure weakens the currency further. The weakening currency makes foreign currency debt more expensive in local terms, increasing the likelihood of default. The default risk increases selling pressure. The cycle accelerates. What makes currency crises particularly destructive is contagion, the spread of financial stress from one country to others through multiple channels. Direct channels include trade relationships and financial exposures. If investors are burned in one emerging market, they often reduce exposure across the emerging market category, selling assets in countries that may have no direct economic link to the original crisis country simply because they belong to the same investment category. The Asian financial crisis of 1997 began in Thailand, spread to Indonesia, Malaysia, the Philippines, South Korea, and Hong Kong, and ultimately affected Russia and Brazil. Countries with limited direct economic ties to Thailand but significant exposure to the same category of investor sentiment. Contagion moved faster than economic fundamentals could explain. Here is what most explanations of global finance leave out, and what changes the picture entirely when you include it. The global financial system is not primarily a technical infrastructure. It is primarily a confidence infrastructure. The dollar is the world's reserve currency not because of a law, not because of gold, not because of a formal international agreement that requires it, but because enough of the world's major institutions, governments, and market participants continue to believe it will remain so and act accordingly. That belief is self-reinforcing. As long as global trade is priced in dollars, countries need dollars. As long as countries need dollars, there is demand for dollar-denominated assets. As long as there is demand for dollar assets, the U.S. can borrow cheaply. As long as the U.S. can borrow cheaply, dollar dominance continues. But the same mechanism that makes the system stable makes it fragile. Confidence is not a physical resource. It doesn't deplete gradually and predictably. It can disappear suddenly. The 2008 financial crisis, at its core, was a confidence crisis, a sudden, system-wide loss of trust in the value of mortgage-backed securities that froze credit markets almost overnight. The global financial system is the most complex network of interdependent trust relationships ever constructed. Most of the time, it works. When it doesn't, the effects are felt by ordinary people, in unemployment, in inflation, in currency values, in access to credit, who had nothing to do with the decisions that created the problem. Understanding the system doesn't give you the ability to predict when it will break. But it does give you something more valuable than most people have, a mental model of how things are actually connected, so that when something happens in a corner of global finance that most people have never heard of, you have a framework for understanding why it matters. So here's the framework for carrying all of this forward, knowing that the specifics change constantly while the structure remains. The dollar's reserve currency status is not permanent and not guaranteed. It has persisted because the alternatives have not yet achieved the depth, liquidity, and trust required to replace it. The gradual development of alternative payment systems, the accumulation of non-dollar reserves by central banks, and the ongoing geopolitical tensions around dollar-denominated sanctions all create long-term pressure on dollar dominance that is worth watching. SWIFT and correspondent banking represent infrastructure that is both essential and increasingly contested. Understanding which institutions and countries are working to build alternatives, and why, tells you something important about the long-term architecture of global finance. The Eurodollar system and shadow banking are the parts of global finance most likely to be at the center of the next major crisis. They are large, complex, partially opaque, and interconnected with the traditional financial system in ways that are not always fully visible until stress reveals them. The IMF and BS represent the global financial system's attempt to manage its own instability, to coordinate policy, set standards, and provide emergency resources when the system's self-reinforcing confidence dynamics run in reverse. Their effectiveness is real but limited, and the terms of their interventions always involve political and economic trade-offs that are worth understanding. And currency crises and contagion remind us that in a globally connected financial system, no economy is fully insulated from what happens elsewhere. The circulatory system metaphor holds. When the circulation is healthy, the effects are invisible. When it's not, they're everywhere. Most people interact with the global financial system every day through prices, interest rates, exchange rates, and economic conditions without knowing the system exists. Now you know it exists. That's the beginning of understanding why the world works the way it does. Bye-bye amigos, and remember, no money, no honey.